welcome to the second of our breakout sessions, concurrent sessions. This is the life insurance and the health insurance stream, so if this is your room, I'm sure you found your way here, so thank you. Conversation for this particular session is titled, Is Consumer Change Driving Regulatory Change? The Impacts of Consumers of Global and Regional Regulatory Change. We've got an absolutely awesome panel here. We are, after Clare speaks for a moment, I'm going to actually ask them to introduce themselves, but we have Becky Mcclelland, who's Chief Risk Officer at Partners Life. We have Clare Bolingford, who on this is the Director of Banking and Insurance Conduct at the FMA. Still is, thank you, Clare. We have Emmeline Rushbrook, partner at Russell Mcveagh, and also delighted to welcome a Aussie colleague, Briggs. He is the CEO of the Financial Services Council in Aussie, so we're going to get a really good sense of what's going on. Folks, you hopefully saw the previous slide around how to ask questions, so this iPad's going to be very interactive. This is your session as much as it's our session. The way we'll run today is I'm going to invite Clare just to say some opening comments, just really to kind of set the scene, and then we're going to jump into a discussion traversing the topic. So without further ado, a really warm welcome to Clare Bolingford to kind of lead us on. Clare, welcome.
Tēnā koe, Richard. Tēnā koutou katoa, ko Clare tōku ingoa. Ko taku mahi ki te mana tatai hoko hoko, the Financial Markets Authority. And I would like to say thank you to the FSC and to Richard for inviting me to talk about a topic I'm very passionate about, consumer-driven regulation. But there is certainly a lot to talk about in this space right now, with much of it relevant to insurance providers. An obvious issue that I will mention up front is climate change and the global response driven by people calling for action, leading to what we in the public sector call regulation. The regulatory response here includes the new climate-related disclosure rules requiring our biggest companies in New Zealand, including many insurers, to disclose their climate impacts. It's a great example of consumer change driving regulatory change. Also, of course, reflecting that big institutions are aware of the growing demand for disclosing these risks and preferred a level playing field created by a consistent legislative regime. And another one, and my favourite specialist subject for those of you who know me, is the Conduct of Financial Institutions regime, or COFI, as it's known. So Kiwi consumer advocates have long called out what they see as a power imbalance between an insurer or a bank and retail customers, especially when things go wrong. Many called for a commission-style inquiry after seeing the systemic failings in Australia, and there was a bit of a discussion about some of the differences in the last panel session between Australia and New Zealand there. But the New Zealand industry have avoided that spectacle here because the regulators advocated for joint culture and conduct reviews, and these reviews have led to consumer-driven reforms. We are no longer an outlier when it comes to embedding conduct obligations in our financial institutions. So that work helped deepen the FMA's understanding of the bank and insurance sectors, and that's work that we want to continue. It's enabled improved engagement with the industry in seeking to root out conduct problems and prioritise the interests of consumers. When we asked firms to go and check back on their business for signs of poor practice, we did find, and indeed are continuing to still be informed about, multiple issues that have negatively impacted their customers and some unfair treatment. Many of those have now been fixed and customers put right, but many are also still being worked through. And I do expect that more will continue to come to light, particularly in firms that have not yet properly tested in the areas where harms to customers can occur. But importantly, our engagement over this period has helped in shaping the kind of industry and the kind of regulatory principles that everybody wants to see and should be able to agree with. So, what is the essence of COFI? As we heard in the last session again, it is the prioritisation of a fair conduct principle ahead of a more prescriptive approach. It's a move away from box-ticking compliance towards a focus on outcomes, including a proactive analysis of how products are performing for customers not just the business. It puts the onus on the institution to consider what fairness looks like and then to formalise that in what's known as a fair conduct programme, specific to each entity. These programmes will need to be approved by the firm's board before they apply for a financial institution's licence, which they'll be able to do from next year. The programmes are intended to inform the entire business as to what fairness means, from the design of products right through to the handling of claims. And once the regime is in force, we will be holding insurers to account. So staff will know what fairness looks like, and consumers will know what fairness looks like. But we've also been told in our research that consumers don't always know where to go when things go wrong. This is one example that an effective embedded fair conduct programme should address. But that's not to say that positive change hasn't already been happening, because it has. Since our 2018 review of life insurance culture and conduct, many providers have been evaluating their products to ensure they are fit for purpose and self-reporting any concerns to us. In that time, almost 4 years, 225 such issues have been reported to us involving life insurers, many the result of creaking systems and weak controls. Nearly 500,000 customers have been impacted and more than $43 million paid in remediation, and that's just for the 1/3 of issues where the impacts have been fully assessed. It's worth remembering that when we first reported on remediation in September 2019, insurers that had at least undertaken reviews identified 75,000 customers impacted, with a value of at least 1.4 million. Last September, we also highlighted CCRI as a product that has had low or poor value for large numbers of customers, not helped by the way it was sold. The more firms have looked, the more problems they've found. We've recently taken action against one life insurer as a result of issues caused by customers not having the right information or having decisions made for them that weren't well communicated. It's highly likely that there's more self-reporting to come as firms continue to look for and find other historic issues. You can reasonably expect that our future monitoring activities will consider how well firms have completed and reported on these matters. I do want to acknowledge the substantial work done on these problems to date, especially those looking back further than they have to. Many of the boards I've attended over the past 12 months have displayed a greater understanding of what needs to occur, but my message to them continues to be that the completion of conduct action plans is not the end. A more fundamental shift is still needed to bring customer fairness into all aspects of decision making. Life and health insurance are long-term products which many people keep on buying for decades, often with the same provider, unquestioningly and faithfully. But sadly, some customers only find out there are issues with their cover at claim time, which is too late. That's why it's so important that features and exclusions are properly understood, as well as how premiums are set. Simply because if mistakes are made, or information is omitted or hard to find, that loyal customer mightn't find out about it until they or their family are told they weren't covered after all. That's too late, and it's not fair treatment. So greater transparency, better communication, and more customer understanding to support those big financial decisions are what I'm hoping to see more of as COFI kicks in. So to answer the second part of this session's title, how these changes will affect consumers, I'll answer with another question. So what does treating customers fairly look like in practice? One key part is not subjecting them to unfair pressure or tactics, so they don't feel rushed into making those important decisions. It means helping them to understand how financial products work, ensuring they know about exclusions or what could happen if they don't disclose all relevant information. Again, a topic we just heard discussed in the last panel. It also means giving them the confidence that financial institutions and their intermediaries will have the same principles and guidelines in mind and are actively supporting their financial well-being. I think that last one is particularly important because we know Kiwis have quite low rates of life insurance compared to overseas. So research by the FSC a couple of years ago found 62% have no life insurance. And the key contributors to this were that it's seen as a low priority and a lack of trust. We heard even more research from the panel in the last session about some of those more up-to-date figures as well. So clearly there's still a problem. In fact, I was talking to a younger family member recently, well, younger than me anyway, someone who's just bought a house, is well-educated, well-paid, and well and truly disinterested in getting life insurance. And when I asked why, their response was, well, I just haven't given it much thought, and then I don't really know why I need it. And I'm sure many of you in this room can think of quite a few reasons why they would benefit from life insurance. An obvious one being the fact that they'll be covered for later on for any issues that might arise, say, for example, as part of the 20-year-old Kiwi lifestyle that some of us might have led in the past. At least I was in the UK at that point. But my relative isn't hearing such reasons, and I suspect many more Kiwis aren't either, which may indeed be a potential downside of regulation for consumers. The right conversations may not be happening at the right time. We know, for example, that there's been a drop in over-the-counter sales of insurance at banks, perhaps in part because staff are worried about the consequences of getting the conversation wrong. So there is a risk that customers don't have good access to quality advice or good conversations about products that may be suitable for them at the right time. To which I'd say this: that is not the intention of conduct regulation at all, quite the opposite. Put simply, treating customers fairly means equipping staff and advisors with the right information to enable good conversations, but ensuring it is done with the customer at the front of mind. That's one reason why we're working so hard to get our intermediated distribution guidance right, to ensure providers and their intermediaries are all behaving in a way that's consistent with the fair conduct principle. And we'll continue to engage with industry to focus on how to most effectively embed the regime over the next 18 months. One of our priorities is to continue building our understanding of consumers in the sectors we regulate, and we will share those findings. We've recently completed our first major survey on consumer behaviours and attitudes towards financial services, and two of the key findings stood out for me. So only 31% of people are confident in knowing what to do if they experience unfair treatment. And on the other hand, 70% of insurance customers were satisfied with their insurer. The top three drivers of this were that they felt their insurer provided a good service, that they felt that the product was fairly priced, and that their insurer is easy to deal with. So 2 key points here. 3 out of 10 of your customers aren't satisfied. It's great that 7 out of 10 are, but how do we get the other 3 out of 10 over the line? It's a product sold to hundreds of thousands, if not millions of people. And that's a lot of people that aren't satisfied. And that consumers are pretty clear on what they want and what they expect. And that's what's driving regulatory change in New Zealand's financial sector. Thank you very much. Tēnā koutou katoa.
Well, thank you, Claire. Provocative, insightful, and probably give us all a little bit of food for thought. I'm just going to invite the rest of the panel to introduce themselves, and then we're going to jump into the discussion. As ever, if you have any questions and you want to join the dialogue, just flick some questions through on the app, and we will try and get to them when we can. But Emmeline, I might start with you, if that's okay.
Well, kia ora koutou. Thanks for having me here today. I'm a partner at Mcveagh. I'm a litigator. I then moved to London and spent a lot of time working in Canary Wharf post-GFC, when conduct really became a big thing in the UK. So since I've moved back to New Zealand, support banks and insurers largely on conduct and culture issues. So Kofi is also close to my heart, as is conduct. I'm really behind the policy intent. I don't necessarily think we've got the legislation quite right, but I'm sort of rolling up my sleeves and partnering with people to get the best outcomes for New Zealand consumers.
Awesome. Thank you. Becky.
I'm Becky Mcclelland. I'm the Chief Risk Officer at Partners Life. I'm going to come at this from a little bit of a different angle, I think, today, because I actually think in life and health insurance that consumers are not driving change in the same way that they are in investment, perhaps in banking. So I think we're going to have quite an interesting conversation.
Thanks, Becky.
Blake Briggs. I'm the CEO of Financial Services Council for Australia. We represent, I think, effectively all the same sectors that the FSC does here, but obviously have a very different lived experience of financial services regulation, and happy to bring an international opinion to what we did well and what we didn't do well. So.
Awesome. So that's a great scene set, and there are already some, I won't call them fault lines, but certainly discussion lines. Because I think, you know, for all of us who've lived change, it's almost like this tension between what does government policy want, what do consumers want, how does the regulator regulate, and how does the sector respond? And all those things kind of end up in a mixed master, and you end up at an outcome. And there's always, you know, no one's ever on the same page. There's always kind of those tensions. But Becky, I might go to you first just to unpack your opener, and then we'll maybe head to Clare after that.
Sure. So I do come at it from a little bit of a different angle, and I say that because prior to working for Partners Life, my background was wealth and funds, and also in banking. And I definitely see that kind of disruption coming through from consumers and the demands and this kind of smartphone apps that we see and Sharesies and all of those types of innovative products. And I just don't see at this stage consumers engaging with life and health insurance in the same way. And I think that's a really interesting piece. There's a piece around, and we've heard about it a lot today already, around financial literacy and whether or not people actually understand what these products do for them and why they need them, to Claire's point about her relative. So there's that piece, there's the financial literacy piece. We've talked a lot in the panel previously about underinsurance gap and what that means for New Zealand. And I just don't think that presently consumers really understand what life insurance and health insurance can do for them. I think we've seen a bit more post-pandemic of people understanding the benefits of health insurance for them, for sure, but we're not seeing that translate yet into the need for income protection. So it'll be very, very interesting to see what happens with the government scheme and how we respond to that. But yeah, I think that our job as industry is we're trying to innovate and do that for consumers, absolutely, but it's more around trying to get them to understand why they need to have those conversations and giving them the breadth of different channels for them to have those conversations. So whether it be with an advisor, direct with the product provider, digital, however it is, and trying to do that by giving them the ability to get advice with it.
Thanks, Becky. Emmeline, I might go to you on this topic. What's your take on that kind of difference between sector driving change versus regulation driving change versus consumer driving change?
I would tend to agree that that I don't think it's consumers driving change in this industry. It does seem to be, my particular focus being COFI here, where I do think it is the regulator responding to that, to the figures that Claire's just put to us about the remediations coming out, and just a real sense that there has been an underinvestment in systems and control. So hopefully that's going to result in better outcomes for customers, and hopefully they're experiencing that now as enhancements are put through. But I think that's not so much the consumers themselves, and maybe that relates to financial literacy. But it's just, I think it's come up before today that these are different products than buying a hamburger, right? You know immediately if there's something wrong with your hamburger, but you don't if there's something wrong with your insurance policy. Is
your sense that the sector's kind of played catch-up? So from the Royal Commission to Conduct and Culture, the last 3 or 4 years have been just huge investment in time and energy to kind of get to base camp. Is that something that you see?
I definitely have seen a huge amount of work across the industry, and I do still think that, my perception is that people are at different stages on that journey of understanding how deep you need to go in terms of reviewing your systems and controls. But yeah, certainly I think everyone's progressed markedly. I think there is something unique about insurance products, that there's been in this, I'm drawing on London experience here, there's sort of been a mystique about them, and people, it's a little bit like commercial contracts, people enter into them and then put them in the bottom drawer, and there's some experts in the organisation who understand features. So, my aspiration for the industry, and it's not actually just consumers, but everyone through the organisation who has a consistent understanding of what products they're supposed to be doing.
Yeah, cool. Thank you. Blake, I might go to you because in many ways, much of what's happened here in the last 3 to 5 years was triggered by what happened in Australia, and there are obviously entities that operate across jurisdictions and across the world. Perhaps just paint that picture for us in terms of what happened and what's been the impact in the Aussie market.
Yeah, so look, there's been a fairly long train of regulatory change and examples of misconduct identified, which culminate in the Royal Commission process. But by and large, a lot of the sectors that I represent had actually been through a process of incremental regulatory change for a long period. There were parliamentary inquiries, recommendations that flowed through. The Royal Commission was kind of the culmination of that, and then we've had a better part of 4 years now of implementing the recommendations that came out of the Royal Commission. So when you think about changes to systems and product design, it hasn't been consumer driven, except to the extent that they're being done in the name of consumers to better protect people from what we saw. The net result, though, is we're starting to see, not all regulation that's done in the name of consumers actually necessarily helps consumers. And financial advice in Australia is a good example of that. For those who know the market well, the number of advisors has absolutely collapsed over the last couple of years, and it's almost impossible to provide quality advice at a price point that's accessible for most Australians. And so there's starting to be the green shoots of a discussion around, okay, what of it is necessary and necessary to keep in the future, but then also which of it was regulatory overreach isn't the right word, but actually counterproductive from the outcomes we're trying to achieve. And so it might be too early to be optimistic, but I like to be.
So in the Aussie life market, obviously there was following a similar process here in terms of unwinding of entities playing in the life insurance market, selling and big life companies bulking up and so on. I mean, what's your sense of progress now? This is 3-4 years on in terms of the state of the nation, in terms of life insurance and kind of getting back to the point where consumers are going, I trust the system, I'll trust I get looked after, I'll trust what I'm buying.
So first of all, it's a very different life insurance market from what we saw a couple of years ago. There are no Australian life insurers left. They've all been absorbed or bought up by big global counterparts. And most of the investment in those businesses have been compliance systems and developments. I think there is still a journey to go through to rebuild consumers' faith that the life insurance industry, serves their interests, but there's certainly a lot of work going into trying to achieve that outcome. So the best example of that is we have quite a comprehensive life insurance code of practice in Australia that's administered by the FSC, and we've just finalised a new version of that. Will be coming out, which has been released, but it's implemented as of July next year, and that has a whole suite of consumer protections in it that are much more proactive than what the previous version was. So it's the industry's way of looking forwards to where we see issues arise in the future and trying to get ahead of that so that the sorts of things that blew up the goodwill several years ago can be averted proactively.
Cool, thank you. Claire, I'm going to give you last word on this in a moment, but I just thought, just for the people who weren't in the last session, I might just go to the Partners Life research, Becky. In terms of what did you find out most recently in terms of how consumers are thinking about life insurance and making decisions and so on?
So I have to be honest, I can't remember the stats like Naomi did just off the top of my head, so I have them written down here.
No, good.
But we did some research. It was basically prior to some advertising that we were going to do, so we wanted to make sure that we were going to be pitching that to the right kinds of customers. 34% of New Zealanders believe that ACC covers them for unexplained pain and illness. So, being off work because you've had a cancer diagnosis or you've had a heart attack, that type of long-term illness thing. This was the stat that Naomi gave you, which was that 13% of Kiwis have got critical illness cover and only 9% have got income insurance, which is just, I found that astounding, to be honest. And then the one that actually worried me the most was around younger generation, and Claire's alluded to this already. 38% of people aged 18 to 24 think that ACC would cover them for time off work if they were diagnosed with cancer, and that same group think that accidents are the leading cause of death in New Zealand, but it is actually cancer. So to the point around financial literacy and misinformation around what insurance is and does and how it helps you, we all know what it was like to be young and think that nothing was ever going to happen to you, but I think we all know someone at this age, or certainly I do, where things have gone wrong. So we have a bit of an obligation, I think, to the younger generation to get them across this stuff and educate them as to the value of insurance.
So we're going to jump into the discussion around how to Yeah, how do we get into the different life stages and different age groups with insurance? But before we do that, Claire, was there anything you wanted to kind of observe around any of the comments that the panel's made to date?
Yeah, look, I think certainly in terms of driving innovation and driving, greater accessibility, whether that's through digitisation or better understanding of the type of products and features. I would certainly agree with Becky and others that it doesn't feel like it's consumers driving that. But in terms of the regulation itself, I think if we go back to the kind of beginning of where we started, which was in Australia effectively, following the Royal Commission, I think people genuinely started asking questions about, is this happening here? And if not, how would we ever know? So I think customers do actually, when they do engage with a product, when they do think about their need for that product, they do have certain expectations on their providers and on their advisors as well, that they will be treated properly, whether that's at the point of sale. And there are remain challenges, I think, around the model where it comes to how conflicts of interest are managed across the piece in the intermediated distribution channels, and how customers can trust that they're getting the right product that is suitable for them. And I also think that bringing in this regulation, the consumer protection regulation, it enables us to have those conversations more effectively. And I know Blake was talking about the investment in compliance systems. As Samantha said earlier this morning, yes, obviously compliance is important, but actually these should be systems that are beneficial for your organisation and beneficial for the consumer, ultimately. So yes, it may be helping to tick, a compliance and legal necessity, but actually knowing your customer better, knowing, keeping proper records, being able to look through and think, are these products actually suitable over time as people's situations change, is going to be incredibly important for those customers. So I absolutely agree with what the panel has said, but I think also, consumers expect more these days, and the industry has to rise to that challenge too.
And I guess in many ways, the challenge for us, wherever we sit in the value chain, is actually to represent the customer. And if we take that perspective, then we're going to design products well, we're going to service customers well, we're going to put in place the right systems and so on. And that's not always been the case. That kind of sense of who is the customer has always been, until reasonably recently, the big debate, particularly in the intermediated space. But I think, my observation, I'm the facilitator, but anyway, my observation is it kind of seems like we've made some progress there. Sorry, step back into the thing. Thank you for all these questions. We are going to get there, so please keep them coming. I'm just going to duck into this conversation about the next generation. So, if we were in the stream next door, which is the investment stream, we might be talking about Sharesies and Invest Now. In fact, Invest Now is on the panel next door. Through COVID, people got engaged in investing and trying out and so on. How come that's not happening really effectively in the insurance space as well as it might? And I'm not sure. Maybe I might just pick on. Anyone want to grab hold of that one? Where you go, Becky.
I do have a bit of a view on this one. So personally, I think if you think about life and health insurance versus shares and and that kind of thing, life insurance is pretty boring, really, isn't it? I mean, you don't buy it. It's not zhuzhy. It's not sexy. You're not like seeing it change day to day, making changes to your portfolio, that type of thing, in the same way that you can get from Sharesies. In terms of life insurance, you hope you never need to use it, basically. So you're buying something that you hope you never ever need to use, and that is a difficult sell, I think, for something in a digital app-based kind of Sharesies type buy-in that you want from younger people. I think you potentially could get it in general insurance. It's a little bit different because it's an annually renewable contract. Life insurance is a long-term thing, and that's why I think it is more difficult. But I do think it's possible if we look at it from an advice perspective. So that buy-in piece, I think that comes through actually the provision of advice around these products and making, well, I said it earlier, seeing the value for people for future.
Yeah, I'll piggyback on that advice point. You really got to get the advice part of that equation right, because what we've seen in Australia is banks are completely out of wealth now. All the places where a consumer feels they would naturally go to have a conversation about fairly simple, discrete issues like, I've just bought a home, I have more debt than I've ever had in my life. It would make sense to be able to have a life insurance discussion with someone at that point of their journey. But, when you walk in through the bank to get the mortgage or you speak to your mortgage broker, they're not allowed to talk to you about insurance needs or anything else because of the financial advice regulations that we have in place. And so it's a really good example of where trying to prescribe what good looks like from a consumer perspective has actually fundamentally compromised the consumer's experience. And if there's one piece of advice I can share without being patronising, it's don't go down that path, because you need to have much more organic conversations with consumers about what they need in order to be able to give them the service they want and get access to the information about topics that they desire. And without that, life insurance will struggle, I think.
Claire, does it bother you that the stats that you spoke about are coming through and that younger people kind of aren't engaged in the insurance discussion?
Well, it does, because it's such a fundamental part of people's ultimate financial well-being, and obviously, as I said, I'm sure people in this room would recognise it's easier to get on the journey earlier in your life than it is maybe than actually when you start realising that you need some of the products that we're talking about. So it is disappointing, and I think it's really for us to think about how we do engage younger people more in this conversation. So, I mean, perhaps one way to think about it is we're now, as part of our investigatability strategy, trying to, and have been for some years, trying to do more about KiwiSaver and helping people understand that KiwiSaver, young people don't want to think about saving for the future. They've kind of been made to because they join up in a compulsory scheme. So, but then, of course, it can sit in a default fund, as we've heard in other sessions, for a number of years, because they're not particularly engaged in what's happening to that, because they're thinking it's all going to happen to them in the future. And life insurance is a lot like that. They don't want to think about what might happen in the future. They don't want to think about bad things happening. So, what can we do as an industry to actually engage them in that debate, to actually help them to understand that this is a conversation worth having, and there's really something in it for them, even though it's a product that is, it is something that's further away. So I would certainly like to see more of that happen.
Just a comment from a millennial in the room. A question is, what are the difference in messages between, say, millennials and other markets that are being used? Is there any research around what works for millennials? And speaking for herself as a millennial, the reason to prepare for my death to get life insurance isn't compelling, as I have no kids and just use my savings to pay for my funeral. So, that's the thing, right? There's a trigger for buying life cover. Why buy something you don't need? Does anyone, I'll either take that as a comment, or unless someone wants to grab hold of is there a way to communicate differently with different parts of the market?
I'm just trying to identify who this millennial is that's thinking about their own death.
That's why we're using the iPad.
It's anonymous.
I don't have anything on that point, but I do think that Naomi's point earlier about just storytelling is really important for people to understand the value of some of these products. And I won't go into my own life story, but I certainly wish that there had been life insurance in my background, and that really goes to the relationship between products as well, which I think is a really important one. It was interesting over COVID time to suddenly watching sort of in real time the relationship between credit products, KiwiSaver, hardship withdrawals, and insurance for income protection coming into play. So that was a real high point for me of the first period of COVID, watching different product providers working out how these are supposed to work. And I think that there's probably more to be done about how are these products working together, including when you have conversations with customers, to your point about taking out debt.
It is interesting, isn't it? Life insurance is obviously it's often a very personal conversation, and we kind of have to reach into our personal lives to figure out what went right or what went wrong. Certainly, yeah. In my lifetime, there's been a couple of key moments, and it's been pretty sad and tragic. Emmeline, just while you're there, we got a question from the floor. You mentioned Kofi legislation isn't quite right. What changes would you make, and what would you like to see?
That was my provocative. If you're going to be a lawyer in the room, you've got to say something.
No, somebody bet. Way you go.
I think my main point, I'm going to accept that Kofi, you know, and I'm kind of happy with Kofi as a concept of there being legislation. For me, I was really keen on only the FMA having jurisdiction. So right now where we've landed is that it's a civil liability provision. So not just the FMA, but also other affected people can bring proceedings against financial institutions and people within those financial institutions if they were involved in the breach. So for me, when I think about the objectives that we're trying to drive from Kofi and the level of confidence, and that I don't want my clients getting caught up in these technicalities and worrying about that stage. And in the UK Consumer Duty, there was an act of choice. We're not going to give that sort of private right to people at this stage. We're not at that level of maturity. So I think that's a real lost opportunity. Maybe we can open it up again for debate. It was certainly something that people put in submissions at select committee stage. But I think that's a real shame, because I think it could have been a moment of sort of trust between the FMA and the industry only, and would have given financial institutions just that liberty to work with the FMA and develop, proportionate guidance and tailor programs for themselves without the sort of risk of, do I need to protect legal privilege over my program and the development of that, because this might show up in later civil litigation and things like that. So that's my main regret about the legislation where it's landed.
So I'll just turn that question on its head and ask Clare. Clare, is there anything else on Kofi that you would kind of want to see? Or put it another way, is Kofi right from where you sit, given that we're kind of really on the runway and starting to roll out stuff?
Yeah, look, I think we've got to a pretty good place with the legislation. I have to say, when I was looking over from the UK and the bill first landed, I was quite shocked with some of the as far as it went in relation to responsibility of providers or oversight that providers had over distributors, and that gave me quite a big worry about how the market could shift as a result of the legislation. So there's been a lot of debate, there's been a lot of feedback provided. I think the policy has landed in a pretty good place, and what we're really going to try to do is keep it at that principal level. So of course, yes, there will be more guidance to come. We're working on intermediated distribution guidance, as I said now. We're working on how licensing is going to work, and we'll provide more information as part of that. And obviously, as we get closer to the regime and have more discussions with industry about what's really needed, what people really need in order to get to that outcomes focus, will provide more clarity. But the important thing for me is keeping it at that principal level as far as it's possible. As soon as we get into detailed guidance, it starts to become prescriptive, because with the, as Emmeline said, with the need to then be very focused from the compliance perspective, from a legal perspective, on making sure that you've complied with all of that, we very quickly get into a prescriptive regime. So I think I'd just ask, kind of, be careful what you wish for if you're asking us for more guidance, because yes, of course, we want to provide it, we want to be helpful, we want to make sure there's a level playing field, but this is meant to be a flexible regime. It's meant to be, you as the entity need to decide what fairness means for you, what fairness means for your customer in relation to your business model, and we're there to help and support you on that journey. And we want to work through any barriers and challenges that you come up against where it comes to legislation, where it might not be clear. But what we don't want to do is think into that prescriptive regime, otherwise, sadly, we'll end up where Australia
I couldn't agree with more than that. We, my observation would be principles-based legislation is always the way to go, and you put yourself squarely, safely into the allowable territory. You don't try to skirt too close to the line, because that's when you get in trouble. But if you keep going back to the regulator asking for a bright line about how far can you go, not only will you probably be unhappy with the answer eventually, but the regulators are also in an impossible position, because next time something goes wrong, and there'll always be something that goes wrong, the regulator will be under an enormous amount of pressure to move the line further along, and then that blows it up for everyone else, and just an incremental process of, it's a very slippery slope. So couldn't agree more with that assessment.
But I mean, all this is right, but it's interesting, and this is a conversation that the FSC's had with the FMA, that actually it's a different skill set, right? So when you go, you make the call, we're not going to tell you what the call is, you make the call. That's very different to, if you follow this process, you will be safe. It's kind of like swimming between the flags on the beach. You can swim anywhere in the flags, but don't get too close to the flags. Becky wants to say something.
I want to say something. Because I think what we're talking here about is the difference between compliance and risk. And actually, we're talking about managing risk for your business that's appropriate for your business. So compliance is an aspect of risk, and it's almost sometimes binary, so it's very black and white. And personally, I'm very, very supportive of principles-based regimes because you can tailor them to your own business, and the regulator, there's no way that they can actually say this is going to be applicable for this type of business and this type of business and this type of business. Now, with a different hat on, developing the code and making that a principles-based code, we had such a broad church of different organisations and different business models that we had to consider, and so principles-based allows for all of that. But it does mean that you have to think about your internal risk appetite, your external risk, your customers, and all of that kind of thing, and think beyond just the compliance aspects.
If I may just pick up on a couple of points there, I completely agree with Becky that this is about risk management, but it's also about potential lost opportunity if we get this wrong. So we are trying to move firms to focus on the outcomes that we want to see achieved, and that does mean good risk management. That means, as I've said, it means good controls, it means good systems being in place, but we need to think about risk as lost opportunities as well, because actually all of the other things that we've been discussing today, in terms of getting people engaged, in terms of helping people understand how these products can serve them well in the future, if we don't do that well because we're too focused on internal compliance, then that's going to be lost. But also to pick up on Richard's point, it is a different capability. It's risk management. It's rather than necessarily compliance. But it's also a different level of capability for the industry to think about in a different way those opportunities for customers. And it's also a capability build for us because we're not used to regulating this way, right? So it's something that we're going to have to develop with you over time so that we don't come in and say, well, we don't like what you're doing here. We don't have a rule to point to say it's wrong, but we don't like it and you've done it the wrong way. We can't be doing that because it's much more of a conversation about, well, how did you get to that answer if you think that's the right answer for you? Can you tell us, can you show us why that's helping you to get towards the right outcome? And that means that we need to train our staff differently from what we've been doing and have different tools.
Hey, Claire, great question for you here, and this kind of picks up a comment that was made earlier. So we've just coming out of a housing boom, and we haven't seen an insurance boom. So the question is, what are Claire's views on frontline bank staff not having conversations with Kiwis around risk, and do you in fact see that as conduct risk?
Do I see that as conduct risk? Okay. So yeah, I mean, I've in the other part of my role, I've obviously been having a number of conversations over the last year or so with bank CEOs, as well as my engagement with insurers, and it's definitely something that concerns me in terms of, I think, the different drivers that are going into why those conversations aren't happening. I think coming back to my earlier point, I think it is a lost opportunity if those conversations aren't happening at that stage, and it's disappointing that's where it's gone. I think talking to the banks, there are a few drivers around that. Some of those are around the changes to incentives. So I was talking to one bank CEO a few weeks ago, and they were saying, well, we pulled the sales and volume value-based incentives. We can see what's coming. We don't agree with that. We do see that as a conduct risk to have those kind of incentives in place. So it's good we've got rid of them, but then we didn't replace it with anything else. So actually, people don't know what to do anymore. We haven't told them, what is the behaviour we want to see? What is it that we actually do to incentivise having those good conversations? And at the same time, there's more regulation coming through, and the frontline staff are being, bombarded with all of these different requirements that they need to learn and they need to understand, and they're worried about getting it wrong. So, some of that goes to the culture of the organisations. Well, why are they worried about getting it wrong? What support's there in place for them to make sure that they are, the organisations have their arms around them and they're supported in having those conversations. And what incentives are there? What sort of performance management is in place to make sure that it's a good balanced conversation to be had? So I definitely think it's an issue because it means good conversations aren't happening. And it would be good to explore, if those are the drivers, how that can be addressed.
Awesome. Anyone else want to pick up on that topic?
Well, all I'd say is if no conversations are happening, then you're leaving the consumer to figure it out to the best of their ability, and a lot of consumers don't have a high level of financial literacy. And so you just got to get balance right between risk tolerance that some conversations won't always be good, but the more conversations you have net, consumers will be better off. And it's a hard balance to get right. But
folks, 10 minutes to go. There's a series of really good questions, and this was picking up our ACC and the research insights about confusion in the marketplace around ACC is going to look after me, everything is going to be fine. So I guess the question for the panel is, so how do we address that? Is that something that the industry should lead? Is it something that ACC should lead? Is it, how do we steer into that kind of almost brand confusion about what insurance will do and what ACC will do? Becky, I might start with you if that's all right, and we'll kind of see where we land.
Well, I think it's actually a kind of combined effort, to be honest. I don't think that it can just come from ACC or just come from industry or just come from regulators or consumer groups. I think it has to be a concerted effort with everybody. And in the last panel, they were talking about the New Zealand income insurance scheme and how that might help. And the first time that I think it was Naomi who said it, the first time that government's actually said that having insurance is a good idea. I mean, just going to pause there for a sec because that's actually quite profound, I think. And we can adapt products, we can adapt to work with something like that if it comes to fruition. But at the end of the day, it can't just come from government and it can't just come from product providers. ACC needs to come to the party as well, and I think generally we just need to be able to be out there and talking more. And I go back again to the point that I think I've made it several times now, sorry, but I just think that people need to understand the value of seeking advice. And I know that FMA is doing a huge amount of work in that space. Obviously, I've got an interest in it, not just from being with Partners Life, but otherwise as well. And I do think that there's various ways that people can engage with that advice conversation, and if they understand what they get through paying tax or what they get through their employers or what they get through product providers, it might lead us to a better place where people actually do have a more rounded financial well-being, which is good for everybody.
Emmeline, any thoughts on topic?
No, I agree that it's a consistent approach is required, and I think probably as Kofi rolls out as well, people should be thinking about, well, which aspects of some of these issues are individual institution issues and which ones are industry ones. So when I think about the FMA has raised a number of times today about people not knowing about complaints mechanisms, you could tackle that on an institution by institution basis, but actually that might not be as beneficial as people adopting quite similar approaches and being really loud about it in a combined way about being able to complain. And it might be the same with ACC, really consistent messaging with a sort of unified strategy across the industry.
Yeah, cool. Folks, I'm going to move on because I think, Becky, you've opened the door to the question around advice, and advice in insurance is such a kind of critical part in terms of getting to the marketplace. So, if we kind of go back to topic around consumer change driving regulatory change, kind of what role does advisors play in that? And let's use advisors as we know and understand, but also think about new channels to kind of allow people to interact. I wonder who wants to pick that topic up first. Becky, again, I might start with you if that's all right.
Okay.
Your answers are just so good.
Oh, thank you. Okay, so it's really around the diversification of distribution channels and how to get people engaged. Right, okay, so I think really that we need to support the range of distribution channels that we have for advice. I think it's really, really important, and I know I'm looking at the FMA table now, I know that you guys have been out there talking to advisors a lot to try and encourage licensing, which is really, really important because just getting advice through a bank or just getting advice through an insurance company is not the same as going to the high street in your local town and going and sitting down with the person who, you know, probably knows you, knows your family, knows, you know, you may have gone to school with them. There's the deep relationship piece, and I think Karen was talking about that earlier on in the last panel. So I think it's really important that we actually allow people the ability to go and seek advice in a way that suits them. Now that could mean building digital tools as well, because some people won't want to go and sit down with an advisor in the high street, or they might not want to go and talk to someone in the bank. So I think there is a place for that, and certainly the new regime allows that and anticipates for it. One thing that I think is really, really important though about this new regime that we've got is that the principles-based part that we were just talking about means that we don't have to design our products and services for one type of customer. And like, I can't stress it strongly enough that as a group of people in New Zealand, we are a very diverse group. We don't want to try and homogenise the delivery of services and products because the regimes are so prescriptive that we have to do that. Principles-based regimes allow us to innovate. They allow us to offer different products and services for different types of customers that are going to be able to meet their needs. And I think that that's really something we should continue to support.
Blake, you spoke about the Levy review, or implied the Levy review going on in Australia. Can you just kind of unpack what's actually transpired in terms of the way advice is given, how advisors are now delivering or not delivering advice to certain types of clients?
Yeah, so what Michelle Levy's looking at in Australia is, you know, advice is essentially unaffordable for most people, and that there needs to be some sort, and both sides of politics have agreed there needs to be some sort of resolution to that. So what she's trying to map out is a path to what layers of regulation can be stripped back without undermining the consumer protections, but to get rid of a lot of the costs built into the system.
Just unpack the costs, like.
So the costs are primarily driven, there's twofold. One is the documentation that needs to go into demonstrating compliance. So, you know, I think you have statements of advice here as well, but a statement of advice in Australia is anywhere between 80 and 120 pages, 95% of which is about demonstrating that the advice was compliant, and the consumer is actually only interested in about 5 pages of it, which is the actual advice about what you're going to go and do. So it's almost absurd. Like, you think about that and you're like, would you design a system like that? Of course not. So there's the documentation evidence to show the advice was compliant, and then there is the regulatory framework that sits behind it, like demonstrating that your advice is in the best interest of the client by ticking a whole raft of steps. And if you haven't ticked all of those steps, then the regulators are allowed to say your advice is non-compliant, not because it wasn't bad, but because you didn't actually tick all the boxes. And so a lot of that I expect will come out in the final proposals as being unnecessary, which will bring down the cost of advice if implemented. However, then you still have the overarching question in the life insurance space of how do you have a conversation with a customer or a client about a topic that they probably don't really want to talk about. And so that goes to the incentive side of the equation. Life insurance is the only space in Australia where we are still in wealth, where we're still allowed to pay commissions, but even then it's capped at 60% with a modest trail for a couple of years and clawback provisions. And so there's no argument in Australia that those should be increased. I think it would be overly optimistic for anyone to think that would change. But there needs to be a model where not only is the advice cheaper, but you're able to have those conversations at a point in people's life where they're actually receptive to the messages they're hearing. And so that's probably the unresolved part of that equation in our jurisdiction.
And what's been the impact? You mentioned that advisors are kind of leaving in droves. Is it because of that, or is there other stuff going on?
So the advisors leaving in drove has been driven by the regulatory piece. So you've had new education requirements, ethics training requirements. You had to pass tests in order to be able to still practice in the profession, no matter how long you've been there. And to be frank, a lot of advisors looked at that equation and said, I'm kind of done. Like, I'm getting towards the end of my career. I don't want to have to go off and go to tertiary education in order to be able to still practice, and so I'll leave that to the next generation. The net result is there's no pathways into the industry yet, so there's not many new entrants. the banks are out, so they're not funding the development of new advisors in the industry. And as the old stock of advisors rolls off, it's probably a harsh term, but as they roll off, they're not being replaced. And finally, the economics of running an advice business aren't very good at the moment until some of these changes are made.
So, sorry, last one, just following a
So don't go down this path, is I think the moral of the story.
It's kind of like the microcosm case study, but then there's a whole bunch of clients that might have been looked after by these advisors, right? So coming back to our topic here, which is ultimately how do we best serve customers?
Yep.
What's kind of ultimately happening in Australia for if the unadvised or your advisor says, sayonara, I'm out of here?
Yeah, so there's two problems here. One is the unmet advice need, where people aren't getting advice when they would benefit from it, and for want of a better term, the orphan clients who had an advisor and are no longer being serviced, particularly in the investment space. If they've made investment decisions and structured portfolios based on advice and their advisor exits, who is advising them as markets turn like they are now? Particularly in areas like self-managed superannuation, where you might have your entire accumulated life savings and you're responsible for looking after it, and there's no one there telling you what to do anymore or helping you in that journey. So it's a huge challenge. I wish there was an easy answer to it, but with 1 second left, I don't think there is.
Right, so thank you for that. We are almost out of time, but I thought we had 5 minutes. Anyway, we're going to just whip around the panel and just go. So question is, if we're sitting on this panel in 2025, kind of what's changed? By then, Kofi's probably settled in, Fizzler's settled in, we've all kind of got used to it. So in 30 seconds or less, Claire, starting with you.
Right, 30 seconds or less. So first of all, I would say that I think this conversation has moved on massively since the Culture and Conduct Reviews, from where we started with the industry to where we are today. So what I would expect to see that it's moved on again, and we have built some of that capability to actually think about how do we focus on outcomes rather than focusing on compliance.
Brilliant. Emmeline.
A similar theme, I think it would just be that people are feeling confident and assured about how to deliver the fair conduct principle, and the one that they didn't get in is my observation across the industry is the more senior people are involved and involved in the conversations rather than leaving sort of junior project teams to do this, the better. So I think full engagement with real senior oversight at some of those key junctures.
Awesome, thank you.
I echo those comments actually, but I don't have anything really additional to add. I just think that I hope to hear that there's been a bit more maturity in the compliance versus risk conversation. You'd not be surprised to hear me say that, but that piece, and also the continued focus on customer. We're all trying to do the right thing, but I'm not sure that some of us know what that looks like yet. And I think that in that, in future, we will absolutely understand what fairness means for customers, because we'll have been through that journey with everybody else.
I'll end on an optimistic note. I think with the growth of things like superannuation, KiwiSaver, and the massive run-up in house prices, there is a lot of household wealth out there. And people will be, particularly towards retirement, but people will have far greater personal wealth and be far less reliant on the government than they ever have been. And I think that's just a huge opportunity for quality of advice discussions about investments, about insurance needs, and it's about making sure that we find ways to be able to have those conversations with customers.
Fantastic. Folks, awesome panel. Thank you for your insights. Thank you for your provocative fault lines. Thank you for your questions. On behalf of all of us here, we're only over 2 minutes and 30. A big round of applause to our panel.